Everybody, what's going on? This is Chris Flowers. I'm the executive producer of the Biz Coach show, our first show of 2025. As always, want to introduce the one and only Eric T. Whitmoyer. He is the founder and CEO of My Biz Coaches. What's going on there, El Jefe?
I'm doing well, Chris. I'm glad to see that you've rebounded well from the holidays and all the sickness that we were dealing with.
Improvise, adapt, overcome, man. We got to drive on.
There we go. There we go.
And we got Hayden Greene with us. He is director of operations for National Credit Partners. Met him through my days when I was doing more full-time lending, and wanted to get him on the show because I thought you guys would have like a really good synergy together. So I wanted to make sure we got him on the show. Hayden, how you doing, buddy?
Good, man. Thanks for having me on the kickoff episode of the year. It feels special.
Yeah.
Really, we're trying to get people set up the right way, and if things got people got jammed up, during 24, we're going to try to help them, get out of that mess in 24 and get them on the straight in 25.
Absolutely.
Good deal. Well, Hayden, thank you very much. Appreciate you being on the show and excited to get into some of the topics we're going to talk about. I know not all of it is directly what you do, but it is relevant to a lot of the clients. So as we get deeper into the content of your material, I should say more specifically, your product solutions and how you help your clients, I think that our clients will see a lot of value in a lot of things we're going to talk about today. So first of all and foremost, one of the things I have to say, I just got to put it out there up front. I already know you know this because we talked about this on one of our first conversations, but a lot of our clients unfortunately make the mistake of getting into business, getting their business up and running. They don't actually establish business credit. They leverage their own personal credit, which we know and understand that that's part of the gig. You got to do that initially, maybe. But once you get the business up and running, you want to try and transition it from personal credit into business credit. But many of them don't. Actually, my experience, at least a lot of the people that I'm dealing with now, have never considered, or if they did, it just started thinking about it. And unfortunately, often now what they've done is they've kind of extended themselves. The business might be in a slow spot, seasonality, whatever, right? And now they're looking for a little bit of extra capital to get them through a slow time, maybe some unexpected expenses. And now they're struggling because they can't get the kind of credit that they really would prefer to get, right? The premium stuff, better rates, better terms, whatever the circumstances might be. And so we see the gamut of it, right? And as you and I discussed, as a business coach, my primary focus is driving sales results and helping with marketing and overcoming operational concerns and things like that. But what seems to be an ongoing problem, and I'm not sure if I shared this data with you specifically, but I've heard on the show many times we uncover the challenges that clients have, and it's very specific to often, we see the failure rates. They run at 25%-ish, somewhere in there, give or take a few percent within the first year of a startup. Within the first 5 years, it's pretty close to 50%. And typically most companies, 75%-ish, don't make it 10 years in business. And the number one reason that they don't do it, 82% of them claim the number one primary reason, cash flow issues. No, either lacking sales and don't have it and can't get access to capital when they need it, or be able to leverage a credit solution when they need it. And consequently, they get themselves backed into a corner. And that's when we see a lot of these businesses fall off. So I'm opening the conversation with that, because that's a big reason why we wanted to have you on, is helping people identify. And you said that right before the show, get the credit before you need it. Get access to the capital before you need it, because if you don't, it's going to cost twice as much and it's going to be that much harder to get, right? And so it's much better to try and get it up front. That's what we're constantly promoting to our clients. So do us a favor, share a little bit about what you guys do with your organization and how you help your clients at National Credit Partners.
Sure. So we're a business consulting firm, and we've been around for almost 10 years and helping small businesses manage their unsecured debt specifically. We do spread out some other directions, but the real wheelhouse that we work with is unsecured debt, primarily because that is an area that is really the lowest hanging fruit that you can create some benefit into a business's balance sheet. A lot of people follow the Dave Ramsey's of the world and the financial advisors and people that have these brilliant podcasts and thousands of followers. one thing that he always talks about is if you're going to be working on your debts, the highest cost debt, the highest interest is always the one you want to pay off first. And by rule of thumb, that's always the unsecured debt. So with businesses, when we start talking with them about their finances and their liabilities and how everything's lined up, it's very common that that portion of their finances, their liability starts to be growing to be just overwhelming, and it's sucking out all their profitability.
Absolutely. And that major challenge, right? I mean, that's when the credit is sucking up the cash flow and you're already often, dealing with lean margins, that dramatically impacts the business. And it's ironically, as a business coach, one of the conversations I have with them, so many of our clients are service-based businesses. So they determine their own prices in many cases, right? It's not, you don't have a true hard cost of goods sold. So it's based on if they're not good at job costing, which is even worse yet, that they're likely not pricing themselves correctly. And they're probably already underpricing relative to what they should be charging for their services. So they're operating on lean margins, and then they're getting beat up because they borrowed or whatever the case may be. And they're using credit, and that is just crushing their margins at that point. They're really sucking up any cash flow that they had coming in.
Yeah, I always look at debt. I look at it has to be like the precursor to an investment. And a lot of people will look at it because it's easy, with fintech getting to where it is and embedded finance getting to where it is today. A few presses of the button in your point of sale system, and you can have $10,000 in your account. Yep. It's that easy. Yep. So people break away from the common rules of thought of that. If you're going to take on the debt, you got to understand the cost of that debt and carrying it. And then what are you going to put it towards, and what is the opportunity out of that? And is the ROI going to outpace the cost of the debt? And then you got to come up with contingency plans. What's a backup strategy and an exit strategy if those things don't work? And very common, the reason why clients are coming to us is because they didn't have that exit strategy in place. And maybe the opportunity they had wasn't as solid, fell through, or didn't even outpace the cost of the debt that they were taking on. So looking at every dollar that you take on as debt as an investment, how you're going to get the money back. If only the Federal Reserve did the same, but it's wise to look at it that way.
Yeah,
absolutely.
Was it Benjamin Franklin that said like a half an ounce of prevention is worth a pound of cure or something?
Yeah.
That's the thing, and coming from the lending side myself, like I said, every time I get a client coming in like, hey, yeah, I got all these MCAs and it's sucking the life out of my business. Like if I could have got a hold of you, I could have got you to Eric, or if I could have got a hold of you 6 months sooner, we could have prevented all this crap. You know what I mean? Because there's a lot of other ways that we can go about this and things like that. And then they're coming to me for like I said, okay, I worship Jesus, I am not him. So but when I got to meet you, where where you can help out with some of these MCA things and like that, everybody wants to microwave quick and easy, but it's like they're not even looking at exit strategy. You're not looking at, and that's the thing, like so we can just develop that plan prior to. Obviously, we don't have to go through these kind of things. But now, when people do have these multiple MCAs and things like that, how is it you at National Credit Partners? How do you guys go about negotiating these kind of things for them to help get them some relief from those weekly, and daily sucking of their cash flow out the door?
Yeah, well, so there's no one size fits all type of solution. Really, we have to tailor our service to each one of our clients and their situation, their lenders, and then the particular relationships that we may have with those lenders. And sometimes, a simple reconciliation makes total sense for the lenders and and all parties involved. Other times, clients are coming to us in severe situations to where they're a week away from a summons date, and they need representation. And luckily, what seems like just a road to nowhere that they don't even know how to handle. We've done this for 10 years, and good chances are we know the counsel on the other side, so we can very quickly get them caught up to speed, handle the situation, and mitigate risks that could potentially end their business or put them into a bankruptcy type of situation.
Yeah, that's got to be one of the biggest disappointments. I mean, you get a business started, the last thing you think about is how this could go badly. And you made the comment earlier about having an ROI on on your debt, right? An ROI on if you're going to borrow, what's your strategy for that? And I've seen people borrow money because they had an inside track on a bunch of inventory that they didn't have an outlet for. I've seen people, borrow money for new equipment that they didn't employ. They didn't have a strategy on how to employ it immediately. And so 6 months later, they're still paying on the loan, the money they borrowed. And worse yet, they borrowed at a high interest rate on one of these other programs, not like a standard term loan, or something that would have been a little bit more manageable. And ironically, I sit down with them and I say, what was your logic behind that? Oh, I was going to do this. And I'm like, is that what you normally do? Is that your primary business? No, I just thought I could make some good money on it. I'm like, well, if you had the outlet, maybe, but I'm not sure that was the right strategy. So I love what you said, right? Having a plan for this before you jump into it, because as a coach, that's my philosophy. I'm like, let's make sure we have a good strategy on what we do with this before you take this debt on. And then, when we get to a point where, okay, now it's untenable, right? Now we've got to try and salvage it from the jaws of the pit of despair. What are the solutions? And I shared a little bit of my personal story with you in regards to my trucking business and kind of where I ended up in that. And I danced with the devil as well, and got burned. And the loans that I borrowed, I had a good strategy. I just didn't account for one of the things. I didn't go far enough in that planning strategy to account for something that I probably should have seen, I didn't see, and consequently, left me in a spot. And I really wish I had I'd known you guys at the time, because of what I went through with the MCA loans and trying to get out from underneath that was a whole nother nightmare in and of itself. But with that said, you mentioned you customize the different programs for the different clients. Maybe you can share a little bit of insight into kind of what that looks like when you prep a client, and what a client can expect when they get into that kind of a situation.
Sure. One thing I thought of was, you mentioned earlier, you shared your story about your business. It's something I talk with people a lot is, you can always say, I wish I would have gone back and planned more or thought about this. But the reality is our economy and the way America runs, we didn't want you to not shoot your shot. This economy, right. We run on taking on debt and starting businesses. And while 25% may fail, these small businesses are a massive amount of the employment in America. And so,
absolutely,
one time I tell people a lot, which sometimes strikes me a little bit shocking, is that there's nothing illegal about failing in a business or having a business run into a hard time. It's the way our economy works. We want you to shoot shots. The banks want you to take on debt and try to turn it into a profit. And you fail, they want you to dust yourself off and try it again. It's the reality of it. And so, what we started out
being an entrepreneur.
Yeah, exactly. You got to have some thick skin to do it, but
that's
you
right.
got to be willing to take on that risk. And it's what is required. And so when we work with these business owners, first it's a understanding of the financial foundation of their business, how much revenue is coming in, and how much of that is going towards their rent, their payroll, vendors, secured liabilities and unsecured liabilities, and understanding where their cash flow pain points are. From there, assuming we're working with some unsecured lenders, a lot of these agreements, there's the devil's in the details with the language. When it comes to term loans, we got to understand if there's any personal guarantees or assets that are being pledged in the agreement. But then with traditional banks, they have all kinds of consumer protection agencies and laws that you can use to your benefit. And then when it comes to these alternative lenders, like in the merchant cash advance realm, it's wildly different. They're not the traditional banks. They don't run on the fractional banking system, and they don't have the luxury of borrowing from reserve banks. They have to go out and raise capital. So with those alternative lenders, you have to create a compelling reason of why they're going to work with you. And so you got to understand where their loan level is in their investment, what was the ROI that they were expecting to get on that finance agreement, and how we can mediate terms that allows them to get their money back to their investors and still provide an ROI. The last thing they want to hear is, we owe you 100,000, we're going to offer you 50 and call it even.
Right.
So by finding the financial wiggle room we need, the cash flow relief that we need for our business owner, our client, and then proposing a solution to the lender where they know they're going to get made whole. We just need to rearrange the terms. And by the way, we don't do this as a mediator between one business owner and one lender. Our clients tend to have multiple positions. They're the ones that are stacked and leveraged with all these lenders. And so we are trying to fit all these simultaneous negotiations into a new agreement with us, and pass that benefit along to the business owner. Along the way, there's a lot of protections available in case someone comes on board that has already had some effects to their payment history. Some lenders, they've already given them some modifications and they came off, and back and forth NSFs on payments to where they're kind of fed up and they want to go down the legal process. But what we've been really good is trying to see both sides in the deal and provide a solution that is viable for both parties. And the reality in finance and numbers is, we're all in business to turn a profit. Nothing ever has to be personal. And if you can slide numbers over to the other side of the table that makes sense for them, a lot of times they're going to take it.
Yeah, I don't know that a lot of times, at least that wasn't my experience.
Well, yeah, like I said, it's not 100% rule.
Yeah, exactly. It's ironic is I've had 15 different businesses over the last 30 years, and I've run two large scale businesses for two other entities. And I would say probably 80% of the time, you get somebody who's pretty practical when things aren't going well. You can negotiate through that. You can resolve things. But I'll tell you, my trucking business experience was the people I was dealing with, thought that I took their kids and sacrificed them. It was they were out to get blood. At least that's what it felt like. And there was no negotiation. And it was just like, I'm like, look, just let me buy some time here. The terms that we were under were fine up until the business slowed down and I couldn't manage the cash flow any further. And I'm like, look, if I have to shut this down, it all goes away. Right. And they're like, well, we'll come after your home and and it was like, I really wish I had known somebody like you at that time, because having somebody to help step into that conversation would have, I had so much stress and anxiety that I was dealing with that, while I'm trying to hold everything together at the same time. And I can only imagine what some of your clients are going through by the time they get to you, because I know what I went through.
Yeah, there's a wide thermometer on these lenders and their outreach and their tactics. And don't get me wrong, there are some great lenders in the space and good people that really do want to help these business owners. And they'll even come to us directly on defaults that they have, because they know the business is good and healthy and is just in a tough spot. But they're worried about the fifth lender that got stacked in the equation. And so they'll come to us and say, hey, can you reach out to all the lenders involved and get something in place? And if so, we're on board with the agreement you get, that kind of a thing. Right. Because in this world of alternative lending, there are the bigger guys that they're already ahead of regulation and they want to have a clean shop and they want to take care of their clients, because as they grow, they want to have the benefits and the opportunities that the traditional banks have. And as traditional banks start to bleed down and offer the working capital agreements, and SBA starts to offer more working capital agreements, the only way you're going to survive is by playing by those rules, because you just know the regulations around the corner there. So they're more willing to work with the business owners in their situation, but the more high risk lenders, I would say, as a general rule, tend to be a little more aggressive because they knew the position they took. They gave someone a sixth working capital loan, right? And it's just it must just be part of the business model. High rates, high pressure collection tactics, kind of fits.
Makes sense. So, what would be some of the recommendations you make to clients finding themselves in that spot, or at least moving towards that, making those types of decisions to take on those types of debts, so they don't have the same outcome, more specifically, but or maybe some of the things they could look for, and then at what point do they employ somebody like your company?
Yeah, well, so I would say brokers are great to work with when it comes to finding business financing. I think sometimes people think the word broker implies there's a middleman and a commission, and I'll get a better deal going to a lender. And that's not always the case, because when you go straight to the lender, you're
Right.
secluded to their products, as to where a broker can go to the whole world of lending and find you something that, they might get a fee. I've never had a problem with someone in sales making money off of me. I've been in sales my life. It's
Right.
better, did they bring the value? Did they bring the right product? And so I think having a good broker that has a wide range of funding is good once you get there. But also, brokers are still going to be in sales, so they want you to move forward with something as soon as possible. And so I think before you go down the route of saying exactly how low can I get my funding or whatever it may be, get a little more details of what the opportunity is going to go into, because the lenders or funders that you're going to be speaking with, based on the story or the opportunity that you have, it may be more compelling to them to be competitive. Traditional banks run more on black and white models, but in the alternative lending space, they may say this guy has, this FICO is this amount of revenue. This isn't all that exciting. But when you put a 12-page proposal in front of him of a business opportunity where you can furnish commitment letters or anything that's really tangible, well, now that lender looks at it like an investor and say, hey, do I want a 20% return dollar on dollar on this little opportunity this guy's going to flip? Yes, I do. And so, being able to know more about the opportunity that you're trying to capitalize on before you go get the debt for it helps maybe you get more competitive rates. And I guess earlier when we said go look for debt when you don't need it, to clarify, that's more for like lines of credit, right? You can go get business credit cards and lines of credit, things that you don't have to draw from and take on debt just because you get approved for it. Those are like your emergency funds.
Right.
I'm speaking more towards like taking out an MCA where you get funded on something.
Well,
Right.
that was always the problem. Like I said, being and lending myself, it's like people come to me like, "Oh, I need a line of credit. What do you need a line of credit for?" That's the first question. Why do you think you need a line of credit? Well, I need to buy this equipment. I said, no. See, you're already putting the debt in the wrong category. Line of credit for buying equipment. You're already starting on. But that's the thing. They don't understand it. That's it. But then, of course, like you said, just like you said a little while ago, they don't want to pay the broker. Well, like I said, you want to pay me because of the fact that I know what avenue we're going to go down, things like that. But then, of course, I'm going to, like I said, get you over to somebody like Eric to where we can plan this thing out a little bit more detail. But God forbid you already went and pulled that trigger because you got that microwave mentality. Now I got to get you involved, Hayden. And but either way, pay us now or pay us later. You're going to pay one of us sooner. Better to pay us beforehand. Working with Eric, but it comes down to it. Hayden, it's it's in your hands. So, but I think
and I
do that properly and plan for it. Like I said, but everybody has this got to have it right now kind of mentality.
Yeah, entrepreneurs, they like to move fast, and I'm one of those people as well. But move forward cautiously and educated, and you got to realize, in lending, there's a cost to everything. If something seems good, there's a cost to it. So if someone says I can fund you in 48 hours, you're paying for it. If someone says I can fund you on a 2-page application, you're paying for it. The cheapest money you're ever going to find is someone that says, I need an application, I need 2 years of tax returns, 12 months of bank statement, that makes you put together a book report in order to apply and wait 90 days. That's your cheapest money. And so as a business owner, you got to kind of understand that scale. And it's not that it's too good to be true, but you're paying for it. It's baked into the cost.
That's right.
And that shiny object of you want 10 grand in your account now, you're paying for that,
Yeah.
So
go ahead, Hayden.
I'll just say, just as like a red flag of caution to always have in the back of your mind.
Yeah, and I would say if there's an overarching theme, if I said frustration, that's probably an overstatement. But as a coach, I'm trying to help people identify, how to think through these scenarios. So think about it. I mean, running a business, being an entrepreneur and running a business is nothing more than problem solving on the fly all the time. I mean, that's the role of an entrepreneur, right? Is solving problems as they come up, right? Now, a better entrepreneur, a more seasoned entrepreneur, a more experienced entrepreneur begins to identify trends and say, okay, all right, I've seen this a couple times now. Here's a better plan for next time. And that's, as a coach, that's kind of how I position myself. I'm like, look, I've been around the block a few times. I've seen a handful of these things. Let me give you a better solution so that you don't find yourself up against that wall. at the last minute, because that's where I can see you going at the rate you're going. Right. And so, sometimes it's half a step back, like let's think through this through. But the interesting part is that as we talk through a lot of these pieces, like for instance, I mentioned the MCAs, and I would say right after I shut down my trucking business, I probably didn't say a whole lot of good things about they were the devil as far as I was concerned. But the truth of the matter is there was a real tool, right? It was a tool and it was useful for me. I could get the financing for the trucks. I couldn't afford the down payment for the trucks right in the moment. But if I could take the down payment and stretch it over 60 or 90 days, that wasn't too bad. I could manage that. Because once I got the truck and I got the driver in the truck, neither of those were a problem. I didn't have problems getting loads. I didn't have problems getting drivers, quite honestly. The issue I had was getting enough trucks fast enough, because we had like a 98% on-time ratio, and everybody and their mother wanted me running their loads. So, and I say me, but our team, we had 26 trucks. And so my challenge was we went from 0 to 26 trucks in 11 months. And my biggest undoing was I was too good for myself. It's like, and I didn't have resources in place ahead of time. So it was like, wow, this guy wants me to take on these 4 trucks. This is like $1 million deal. I was like, I can't pass up $1 million in annual revenue. So I've got to figure out where to get these 4 trucks. So they approved me for the loan, but they want $40,000 down. I don't have $40,000 in cash. So I go to get an MCA and I string it out over 60 or 70 days or whatever it might be. And I'm like, that's not bad. If I can break even for the first 70 days, then it's a profitable endeavor at that point. At this point, it just folds into my model and I'm perfect. And the only challenge was I took on a fair number of trucks in a shorter period of time, and then got into a seasonality thing where it just slowed down for about 6 weeks and just kicked me in the butt. But my point is I, like you, all of these things, all of these tools, financial tools, are all resources that are available to you. You just need to understand, what you're dealing with, and more specifically, how to make the best decision based on what you're working with before you jump into them. For instance, I as much as I like the blue vines and the other electronic type of loans that are out there for one source, for one type of client, the truth of the matter is they're fairly fast. You said you pay for it. They're fast to loan, but then they never give you enough money. It's just like a little, just a tiny bit of money. And to your point, it's at a premium too, at an interest rate.
Yeah.
But either way, and I think that's, I guess what I was getting at, the whole point is that's a big thing. People need to understand that you're paying for it one way or the other. Right. Whether you're paying for it in interest rate, you're paying it for, like you said, if I go to Wells Fargo Chase and I go get a term loan and I string it out over 5 years, but I'm to your point, I'm showing my business plan. I've got financials over the last 2 years and my budget analysis and all this kind of stuff. And it's going to take me 90 days to close this deal, whatever. You know the space better than I do. But the point is, there's somewhere along the way, there's some kind of investment. There's going to be what's time, series, money, whatever. But it's going to be, I'm going to pay for it one way or the other. And I think if more business owners understood that, they'd think this through a little bit better before they get themselves into a spot where it gets, in a tough spot. And either way, no matter what, you're always going to have a need for your services, because you can't account for everything, right? COVID, 2008, 2001, something somewhere along the way. And we see, every series of 8 years or 10 years or whatever it is, something happens and that affects a series of categories of businesses.
But you see that once again, like I said, they're sitting down with you, Eric, like I said, and they're coming up with a plan, and they're putting away, a cash reserve, things like that. They can weather those kind of storms. So I said, so they took the time, whether it's a little bit of time, they're really passionate about what they want to do. Like I said, they invest in the business by hiring somebody like you to help them with that financial planning prior to, what I mean? So, I'll go back to that, and a half ounce of, cure or prevention is worth a pound of cure, where, like I said, if we can get them to pump the brakes a little bit, let's talk, things like that. We can get them to be successful. We can get them out of some of the stuff. But like I said, it's good to have a resource like Hayden, just because, like I said, unfortunately, people do pull that trigger and they don't see the costs, of that.
Yeah, and a big thing is everyone has their own competencies, right? Like we have plenty of clients that are bright business owners and run great businesses, but they're not financial people.
Right.
They run a great restaurant or a great health and wellness center or whatever it may be. And so, building your team around you and having the business coaches, what you're really doing is your business doesn't have a need for a CFO yet. You're not that big. So you're plugging in that fractional CFO, that fractional CEO kind of bundled in one. So small companies having business coaches, or as they starting to grow, still relying on outside resources, fractional resources before you staff up inside is valuable because you just get more bang for your buck, I feel.
Yeah. So Hayden, tell me this. What are some of the other things? What would a client, as they find themselves sliding down that slippery slope, when do they reach out to you? When's the best time, if we're talking about being preventative, to engage with you so that you can that the situation is the most tenable?
Right. So a big thing to be clear about here, because we are providing a legal mediation service. We're representing these clients, and so this is always something that we got to be careful about because we can't misguide them or tell them anything that's not true. Even though we don't need to be licensed as a law firm, we don't have a certain jurisdiction. We operate nationwide. We always have it in our mentality that what would be the obligations as if we were a law firm, or if we had a bar we had to always keep in good faith with. And so we always want to make sure that we're not advising anyone into a default. These are B2B agreements, and our clients signed up for them. We're not trying to just tell them, hey, we can give you lower payments and everything's sunshine and rainbows. There's just a reality of all these lenders in the MCA space. You call them tier one, the lowest risk ones. They still have about a 3% rate of default on their books. It means for every $100 million they write, 3 to 5 million of that's going to default. The high risk lenders, the ones that are giving you the 1.5 rate factors, they're looking at probably a 12 to 15% rate of default, meaning for every 100 million that they write, they're going to have $15 million default on them. And so with that being the case, there's just a reality that there's a need for our services. So I'm sorry, can you repeat the question again? I had something pop up on my screen
just saying,
talking.
at what point is you started on that path. What point is the right time to reach out to you and begin to retain your
right. So talking about advise them correctly. So we can't advise them to go breach a contract, right? It's like going into a defense lawyer and saying, hey, if I go do this, can you get me out of trouble?
Yeah.
But
what's wrong with that?
I know. What we tell them is a lot of business owners, they're looking at their finances, right? And they're these MCAs, a lot of them take daily payments and weekly payments. Right. And so you have this monthly billing cycle of your MCAs, your rent, payroll, all that. And if you hit a month where you're cash flow negative, the MCAs are still going to take your daily and weekly payments. But when that rent comes around or that payroll comes around, that's where you're going to fall short. And so if you ask these business owners, how would you prioritize your finances in your business? Most would put their employees first, and then rent, vendors, and then at the bottom would be their high interest lenders. But because they get their money first, it's kind of manufactured upside down. And so what I say is, look at your finances, and you got to understand, are you going to default or are you cash flow positive? If you can get through it, this is the agreement you signed up for. But if you can't get through this and your only solution is us or taking on additional debt, which means you're just going to be here next month, right, then you're our client. And so when they come to us, they're either in default or they're telling us they're about to default with a certain day, expectation. And so we allow them into our program, so we know that we're truly working with businesses in a hardship, and we're not working with anyone trying to game the system on the lenders, because the flip side of that is we have to have the respect of the lenders, that now once we got a client, great, we have to go represent them with the lenders. And we see all kinds of wild stuff in this space. Okay, we see our competitors going to court with these lenders and these lawsuits going up to the high courts and back down to the low courts, and MCA contracts being deemed term agreements and back and forth. And we advise people to avoid that whole mess. Regardless of anyone's opinions of, are these agreements legal or are they loans or true MCAs or whatever it may be, there are things that on the tool belt of these lenders that can be very disruptive to your business. Things like enforcing UCC liens and contacting vendors, things like that. And so ultimately, I always bring the conversation back to, we're all business people here, and we're just trying to find a amicable solution to things. And if we can make the lender whole, we can get you through this with minimal effects on your business. But that is something to where when we are bringing on a client, a lot of times they're looking at our competitors and they're looking at other options that are out there. And what we believe is a lot of our competitors may be advising them down a process that their business might not survive because there's just so much friction with the lenders. And with our process being a little more middle grounded and focused around the idea that we do represent the client, but we've never had a client for 10 years. There's lenders that we've worked with for 10 years. And so we do need to respect the lenders and their concerns and find solutions that work for both parties. And that's what will keep the future of this business growing, and future clients have those relationships passed on to them.
That's a great point. And I love that logic. I mean, to your point, you're not going to have a client for 10 years, but the lenders are there for 10 years, right? You're going to continue those relationships. And I think, again, that's valuable for the business owner to understand that, right? This is the situation you're in. I'm going to help you. You are going to help you negotiate through this process. I would be quick personally. I would be quick to side with the business owner, but quickly identify. And I see what you're saying is that, being that person who is playing the middle ground in a sense, and trying to, come to an amicable agreement. You got to be able to play both sides. And I say play, but you have to be able to understand both sides. And
is the juice worth the squeeze? If we say, yeah, we'll go take your lenders to court and fight them to the bitter end, and we win, but you lose your storefront and you don't have any employees and all of your stock is in your garage now, you didn't win,
Right.
And I think everyone's goal on the other side of this is to have a business open and running and keeping employees and sending out paychecks and driving our economy. And that's the goal here. And so while we could be organized around going to court, and fighting lenders in court, we just don't see how that benefits the lenders, the alternative lending space, the business owners. There's always going to be people going into bankruptcy and people finding themselves in court, but it's just not what we advise them to do. We think there's a better way.
Yeah. So Hayden, I'm a little remiss. There was something I should have addressed this before we got into the conversation, but the MCA. Can you describe what an MCA is, and more specifically from an education perspective, what does that loan type look like for the average person who might not be familiar with it yet?
Sure. So MCAs, it's merchant cash advance. As a quick reference, it's a lot like a payday loan for your business. However, it's not a traditional loan in that they're going to give you a lump sum with a set payback and set term. It is what's called a revenue-based finance agreement. So it's based on your business's receivables. And so because of that, it allows the lenders to write what would be interest rates that would be considered maybe usurious. But because they're not loans, they're revenue-based finance agreements, they're not bound by those same kind of restrictions. So they're able to put very high interest rates in there. But also those high interest rates allow them to offset the risk of throwing out loans on very short applications within 48 hours. So that's essentially what it is. It's a financial product for small businesses that looks and feels a lot like a loan, but technically operates different by the contract.
Yeah, and I appreciate you with that because I remember when we met the first time when we had our conversation, I remember you specifically going into that a little bit more in detail, and quite honestly, it educated me a little bit more about that type of loan and where it actually stemmed from, and kind of evolved from. And this what do I call it? I guess it's a tertiary lending strategy. I mean, it's not it's not your traditional banking. And anyway, the point is that I was not as familiar with it. I just saw that somebody was willing to loan me money, and I think honestly, if I go back to where I was 10 years ago in that situation, that's where a lot of entrepreneurs are. They're like, "Oh, you're going to loan me money, and I need money. Yeah, I'll take the money," and they don't have enough understanding of that relationship or what that experience is. But to your point, it's absolutely not working like working with a bank. And you helped me understand that why, which I think I appreciated that. And again, one of the main reasons I wanted you on the show is I really appreciated the time that you took to help me understand the industry a lot better. In retrospect, it's after the fact, but it is what it is. And at this point, as a coach, my most important thing that I can provide for my clients is as much education as I can. And if you know and understand, you can make better, more informed decisions. When you don't know and don't understand, you're making a decision based on emotion or what limited insight you have, and that's often how you get yourself into trouble. So as a coach, that's my primary focus: helping to educate people on business, and more specifically about the things that go into. And one of the things you kind of touched on as well was the fact that these people are good at what they do. This is one of the things I say all the time. You're good at what you do. You're good at being a truck driver. You're running a trucking business. You're good at landscaping, turf installation, being a lawyer, being a doctor, right? You're not necessarily, you don't have a finance degree. You don't have an MBA. You probably didn't do 30 years in the sales world like we did. You may not be familiar with some of this other stuff. So get the guidance, get the insight, and so you can make better, more informed decisions, because that's typically what we find when people are successful long-term. It's because they employ the right type of solutions, either internally or externally, outsourcing, but to fill the gaps in their business that they don't inherently already have the skill set for.
Yeah, especially in the beginning years of the business, because you haven't built that war chest and all that cushion around you. So, one misstep can very quickly start sliding in the wrong direction. So it's even that more important early on, that's for sure.
Absolutely. All right. So Hayden, anything else you'd like to share with the group or with our followers, and any additional insights you'd like to put out there?
Well, no, I think you guys did want me to prepare a little tidbit about maybe what was to come for 2025, or trends that I saw coming around the corner. So maybe we can cap it off there.
Absolutely.
That'd be great.
So a few things, and this is coming out of conventions. We're involved in a lot of the alternative financing conventions, traditional financing conventions, and I have a background as an analyst and reading up on the Federal Reserve and all these happenings. And so, obviously one thing that people are excited about that happened recently, but I do want people to be aware might not continue into 2025, is the lowering of Federal Reserve interest rates. We've already seen a drop somewhat, but there's always a balancing act of the Federal Reserve of managing interest rates and inflation. And when you start lowering interest rates into high inflation, it's something that is not sustainable. So the idea of refinancing or consolidating debts with a lower interest rate, I would be weary of it, in 2025, because it does take quite a bit of a gap in interest rate for you to really see the benefit once you net out fees and things like that. And so, I think we're going to see a bit of a balancing act between the Federal Reserve, which, while you may see interest rates float around, it's not going to be enough to make decisions based off of. So, a lot of people are excited about a new presidential candidate coming into office, and that in itself is not going to save your business. You still got to make informed decisions and decide where the money's going to go. No president has ever stepped in and saved anyone's business, and so still relying on common rules of thoughts and applying the thoughts of every debt dollar is an investment. How am I going to get my return out of it? Will still serve you in any administration, that's for sure. SBA, we will see more collaboration between the government and private sector coming up. As technology around the finance space starts to grow, things start to become more integrated. Data is more available, so banks and lending institutions are able to make more informed decisions. Businesses can participate in their visibility of this data-driven decision making. So small businesses, when they're asking, what can I do to boost my visibility or my credit score? Eric, I know that you have a system that helps businesses become fundable. There's all kinds of things you can do as small as making sure you're using a physical bank, using online banks. Some lenders don't like that. And sometimes even just your phone carrier is like a red flag for some lenders, but small things like that can make a big difference. But big things as well, looking at your debt and the cost of carrying them, and looking at the threshold you're under. rule that I would say to try to govern by as a business owner is know your profit margins. I think every industry usually fits into a general realm, and don't eat up your profit margins with unsecured debt. Remember, you're in profit for your business and your livelihood. Don't work for the lenders. Work for yourself and make sure there's still margin in there, because a lot of lenders will fund all that profit away from your business. Embedded finance is something that I think is going to be great for the lending industry, but is something that could be a bit dangerous for business owners, just because, like we talked about earlier, how easy it can be in some of these systems to press a couple buttons and boom, you have a big chunk of money in your account. That's what I talk about by embedded finance. And so you're going to see all over our devices and our platforms, from your CRMs to your banking systems to everything. You're just going to see offers come in for loans. The same way that you go online and you see these Amazon ads for something that you searched earlier, right? They're going to know when you're looking at capital, or even when you have some slack in your revenue, and you're going to see these ads come in. Same thing, just because they're there and available doesn't mean you need to take it. It's all opportunity driven. The other thing I would say as well is, with embedded finance comes more control by the banks. And what I mean is, if you're a health and wellness spa, there's a very popular system called, I think it's called MindBody. And it's a great platform. You can host your website and your CRM, and all your customers make their payments through it. But at the same time, if you take a loan out through MindBody, your payment history on that loan now directly affects the entire rest of your operations systems. So if you fall behind on that agreement, they can seize everything that your business runs on. And so while there's a lot of convenience and ease and cost efficiencies to these embedded finance systems, I would be wary about what system you personally are taking it through. If it is a system that you rely on heavily, like QuickBooks, you take a loan through QuickBooks, they can freeze your QuickBooks if you fall behind on it. So do be cautious of that, where you get your loans from. Just like how, as a business operator, you want to separate business debt and personal debt, sometimes you want to keep certain things separate within your business's systems as well. You might not want to take a loan through the system that you operate your accounting books on, or your CRM. So
yeah, that's a great added point. I know Square was the first time I'd seen a client. Square was offering, I want to say it was a coffee shop, and Square was offering, you could borrow X number of dollars, and they're like, should I do it? And I'm like, well, what are you going to use the money for? And they're like, well, I don't know. I just put it in the bank. I'm like, not at that interest rate. You don't. And it wasn't horrendous. It's just, to your point, you don't take the money if you don't need it. Right. It's just, but really interesting. And so it's interesting to hear you say that that's going to get even more prevalent. Because, to your point, the next thing that happens then, if you aren't paying, right, they seize up your system. Now how do you transact business? Right. What was interesting is you mentioned that, I started thinking about, in the trucking industry, many times factoring is a very common practice and so if you're factoring with the same company that does your diesel, that could be one of those things that you're talking about. There's a little bit of a conflict there, because that may not work out so well for you if that's but there's a lot of different people that are playing the different spaces. Interesting that you say that. Certainly something to have to consider when you're making those decisions.
Yeah, when you're merging things, understand, is there a true cost efficiency here? Is there a real benefit here? Or am I just getting a single login? Sometimes just logging into a different system could be important to the protections of your business. And we do this for everything. Big companies, when you have the sales department and the servicing department, not everyone's sharing data information. And so similar, if you're going to be taking debt from your lenders, you might not want them to know everything about the inner workings of your business. Because I think a lot of people have seen this as well. You ever had business credit cards where they start to fluctuate the balance on you, and you're like, I haven't even talked to you guys. Why did my balance change? Because they're looking at something that you're not even aware could be popping up.
Yep. Yeah, it's a great point. Interesting. A great insight. That's a couple of different pieces in there that are really important for us to consider as we look to turn the corner here going into 2025 and some of the impact. Just out of curiosity, you didn't happen to make your way to Vegas? I guess you'd probably still be there if it was for the. I'm trying to think of the name of the show now.
I think there's an equipment leasing show there, right?
CES. It's a.
We did not make it. I had it on my proposed agenda for conventions, but we moved offices recently, and so we've been getting a lot of work done around here.
Yeah. We for years in the wireless industry, it was always and now with we've gotten heavily into AI and integrating, talking about how AI integration is going to be a big component for business in general. Anyway, I was reading some stuff from people that are there, and I'm reading some of the blogs and stuff like that, watching some of the videos from people that are live at the show, and I'm like, I'm hearing a ton of AI as an integration into a lot of different things. So kind of interesting to see how it's going to play out.
What I always like is whenever there's a popular convention like this, the following week everyone sounds the same. They have like the same train of thought and the same information they come away with, and so. I used to be a distressed mortgage trader. I was in real estate, and they have these huge conventions all the time. And the week after those, we'd get price bidding coming in, and it was like everyone was pricing something the same, and they all want the same type of product. And you're like, what's going on? They all want the same
You become the Borg. You're like just one thought, one.
Yeah. The CEO from NVIDIA was the guy that kicked off for the keynote that kicked off the whole event. So people are going to be talking about how phenomenal NVIDIA is or something again.
Yeah, I think the next big one we're trying to go to is Debanked in Florida. We have Mike Tyson that is talking at that. So
interesting.
Yeah.
That would be interesting. But how much money he made by giving up the fight to Jake?
Oh, I don't know. I'd go fight Jake Paul too for that. I'd go fight Mike Tyson for that. It's crazy how I think skilled boxers these days are just so good that it's not as entertaining to watch, because when you can dodge everything and play defense, we want to see a Rocky movie. We want to see
exactly
guys slugging it out and hitting each other, and so throw two TikTokers in there. It's almost a more entertaining fight sometimes. It's a terrible fight.
I would agree with that 100%. I miss the days of Mike Tyson.
Wait, before Hayden, I got Eric. Eric used to be actually kickboxing champion. So
oh wow, really?
If he says, "Hey, let's you and I get in the ring," don't take that, dude. Just don't do it.
No, I don't have the lower body mobility anymore. All the football injuries, and I do like to train. I box a little, but if I have to throw a kick above my hip, it's just going to dislocate or something.
I just wanted to warn you that prior to,
That's good. That's good to know. That's good to know.
All right. Well, Hayden, thanks so much. I really appreciate it. This has been great. Phenomenal information, and just great to riff with you a little bit about some of this stuff. Like I said, there's so many different opportunities out there, and I know that the services you guys provide at National Credit Partners are phenomenal. And like I said, had I known of those services at that time, I really, and it's funny because I'm not as close to that space as I was, but I hear still, people are dealing with these MCA loans. They didn't know what they were getting themselves into, and then they're stuck after the fact. So you're on my short list of calls when I hear those conversations, because I know that people get stuck in those spots, and it's not necessarily all their fault. Sometimes it's just a circumstance. Right. And to your point, the whole the U.S. economy is predicated on people going out and taking risk and entrepreneurs starting businesses. I think it's like 62 million jobs or 66 million jobs are provided by small businesses.
Yeah, sounds about right. Yeah.
Yeah. And of those 60 some odd million jobs that are provided by small business, the majority of those companies have less than 10 employees. So it is a lot of small business owners with a handful of people that really move the economy in the United States. And those are the same people that we're talking about that struggle to get 5 and 10 years down the road. So
absolutely.
Yeah, there's anything we can do to help improve those odds and give them the opportunities to make that happen and grow their business. We want to try and do that. So thanks again for your time today.
Wonderful. Yeah, thanks for having me, guys.
Appreciate it. You have a great day.
All right.
You too.
Appreciate it.